Welcome back. For anyone who's wondering about my announcement about the floor and then not having our bill on the floor, there are no hiccups or political maneuvers or anything of that kind. It was just a procedural thing between the clerk's office and the speaker. So sorry for the false alarm. We will have a really great time on Tuesday. So we are going to have an overview of the corporate income tax from Abby Shepard and then Emily Byrne. And then we'll do some more bill introductions after that. Welcome, Abby. We have something on our legislative webpage from you.
Yes, great. Thank you. Can you all hear me okay?
We can.
Okay, great. So under my name, there's just one document today, and that's what I'll be reviewing. And I can share on my screen if you'd like, or would you like to have me up on the screen? What's easier for the committee?
I'm happy to, whatever works better for you.
I can just do it like this, and then I'll call out the slides.
Sounds good. Thank you.
Great. Okay, so I'm going to do a corporate income tax overview. I am just sort of a heads up for anyone who is planning on attending the noon Tax 101 workshop. A lot of these slides are similar, but what I've prepared for your committee is much more in depth. So what you're getting today is this morning is really the deep dive overview, but it's still pretty high level. I'm not going into many specific issues, although I do point out some of the changes that were made last session and explain a little bit about why those were made, just to give you some background before I actually walk through very shortly, but very briefly, what that bill did. So just like we have been discussing with the anatomy and the principles and personal income tax, I will, moving on straight ahead to slide 3, I have laid out the different sort of parts of that calculation that we looked at that is the basic tax structure. So the tax base for corporate income tax is Vermont net income, and that is defined in Title 32, it's Section 5811, Subdivision 18. That's for corporate, so that is different from personal income tax. The tax rates are progressive, and there is a marginal tax rate. So there's that highest rate on the highest bracket, the last dollar earned. There is also a minimum tax for corporate income tax, and the corporate minimum tax is an amount, and it's based on Vermont gross receipts. So it's a different tax base than for the progressive and marginal rates. Those are based on net income. There is also a way of adjusting tax liability, and I'll go into quite a bit of detail about that, and that's allocation and apportionment. It looks at different corporations within one group if they have income inside and outside of Vermont. So that is a way that the tax liability is adjusted, and I've cited Section 5833 of Title 32. So that is the structure, and now I'll walk through who is paying this, what's the income, how do you determine who is taxable in Vermont. So moving on to slide 4, corporate income tax, who pays, and this has its entire slide all to itself, because I really want to highlight that this is only imposed on C corporations. It does not apply to individuals. It does not apply to any other business structure.
What are some example of other business structures that it doesn't apply to?
Yes, that is perfect segue into slide 5.
I'm here for
it. You are following along perfectly. Thank you. So who pays? So U.S. resident C corporations, and then slide 6, I'll talk about other types of businesses who are not subject to this. So a U.S. resident C corporation is an incorporated entity. So they go through a legal process to create a separate legal person, the corporation. Typically, you have names ending in Inc. or Corp., those sort of names that we've all seen. That means it is incorporated as a C corporation. The reason why is to provide why you would choose to incorporate and have that type of business structure is so that shareholders have protection from personal liability, because they are not the business. The business is its own separate legal entity. It's called a C corporation because that's the subchapter within the Federal Internal Revenue Code. Throughout this slide, and sort of colloquially, I might call it a C corp as well. Corporate income tax is imposed at the entity level, so it's imposed on that separate legal person. It does not apply to individual shareholders. Those individual shareholders then will pay personal income tax on the dividends and interest that they receive. So there is taxation at 2 different points, but for a C corporation, it's just on the entity. And I'm saying tax at 2 different points, but they're 2 different taxes. One advantage, another reason why a business would decide to incorporate is to be able to raise money on public markets. A pass-through, for example, cannot raise money on markets. Moving on to slide 6. So speaking of pass-throughs, you'll hear me mention pass-throughs. We will come in and talk more about pass-through taxation, but pass-throughs are sort of a catch-all term for different individual and different business entities who pay tax as individuals. So they're considered pass-through because the income is moving through the entity directly to either the members, the shareholders, the partners, depending on the structure. So you have limited liability companies, sole proprietors are considered pass-throughs, S corporations, so those are small corporations. The S actually is another subchapter within the Internal Revenue Code. So they also have these sort of legal and tax names attached to them, but those are specific business structures. You also have partnerships and the different types of partnerships. Again, those are partner owners, so they are being taxed at the individual level. And that's an important distinction to make, again, because C corporations are taxed at the entity level, pass-throughs are taxed at the individual level. Again, I am preparing a presentation to go into more detail on pass-through taxation for you because there are some exceptions to that rule. In particular, when there are members who are not residents of the state, they can, there is a whole structure for them to be taxed at the entity level. Additionally, there are rules under the Internal Revenue Code and federal regulations that allow for certain pass-throughs to elect to be treated like a C corporation. LLCs can elect, for example, to pay corporate tax and be taxed at the entity level. And that depends on each individual business's structure and whether that makes more sense for them according to their receipts and just how their money flows through. So pause there for a moment if there are any questions about that distinction. I'm really just often when we start talking about corporate income tax and we think about businesses, we sort of mix all business types into C Corps. So I really just wanted to distinguish between the different ways businesses have different legal forms and they're taxed differently.
I think we're all following along beautifully. Thank you.
Great, thank you. All right, so the next part of this presentation is slide 7, and I'll start diving into definitions. So like we saw with personal income tax, Vermont does use some federal definitions. The Vermont corporate income tax is based on net income, which is defined under statute, starting with federal taxable income, plus and minus certain items of income. So it's similar to the personal income, taxable income definition. You have your federal definition, and then you add and subtract depending on the different policy decisions that have been made in Vermont. Slide 7 lists a few of these. So there are no deductions. So federally, there is a deduction for bonus depreciation that's not allowed in Vermont. There are no deductions for non-Vermont bond interest, and there is no deduction for federal operating losses. However, there are deductions from corporate income, net income in Vermont for income added at the federal level, relating to foreign credits and job creating credits. Most recently, there was an addition for cannabis establishments with Act 164 passing, because federally, those sort of cost of goods sold and operating expenses are not allowed to be deducted. So Vermont and other states that have legalized retail cannabis sales have allowed cannabis businesses to take a Vermont level deduction. So that's one of the most recent, so I think that is the most recent deduction that was added in the statute.
Representative Andrews?
Abby, could you explain to me what bonus depreciation means?
Sure. So I haven't prepared anything on that, especially, but so when you have expenses that depreciate in value, federally, there's something called accelerated depreciation. So it was able to be taken all in 1 year. Vermont decoupled from that, both for individuals and corporations.
Thank you.
Certainly, and I could prepare something more detailed than that, but that's the basic principle.
That's sufficient. Thanks.
Thank you.
Back to you.
Great. Moving on to slide 8. Federal taxable income is a corporation's receipts, and there are also allowable deductions at the federal level that I was just touching on, the cost of goods sold. That's maybe one of the most common ones that individuals are aware of, and wages, other employee compensation expenses, interest, non-federal taxes, so state and local taxes, and depreciation, as well as advertising. So those are what's flowing through to Vermont before Vermont is adding back certain deductions and allowing its own deductions. So that's the extent of the tax base. So again, like we have, as I've been sort of insisting on, there are different ways to change the way that corporations in this case are taxed. You can work with the tax base, adding or subtracting. The next area and the next part of your tax structure is the tax rate. And that's where there was some change last session. Like I'd mentioned, there is both the marginal tax rates. There are the marginal tax rates. There's also the minimum tax. So for corporate income tax, you have 3 brackets, and the marginal rate, so that's the top rate, is 8.5%. And that's on slide 9. Just have a nifty little chart here. It's not as, there aren't as many brackets as in personal income tax. So it's, I guess, a little steeper of a progressive curve, but they are still progressive because they have the tiered rates. This is the most recent graph on slide 10 that I found. This is from the Tax Foundation that shows color-coded the marginal rate. So again, this is the top rate paid on the last bracket. What this doesn't show in this graph are the brackets. So it can be on a different, that starting point for the marginal rate, that bracket is going to be different in each state. But just to give a comparison to see, this is one way that tax rates and tax burden, at least tax rate really, is shown when you're looking at other states. Okay, the next slide is number 11, looking at the minimum tax. So this was amended last session. So I did want to highlight the different amounts here that are imposed. And explain how the minimum tax works. So the minimum tax does apply in Vermont to all active corporations, including limited liability companies that elect to be treated as a C corporation. The way that the minimum tax is determined whether it applies or not is whether the corporation has nexus in Vermont, whether they are registered with the Secretary of State, whether they have any business activity in the state. So even if they have 0 receipts, perhaps they have a loss, or perhaps they don't have income attributable to Vermont in that year, there is still a minimum tax owed. If it's $0 to $100,000 of Vermont gross receipts, that's also another important point to note. This is not on Vermont net income, it's Vermont gross receipts, but it's still those receipts that are Vermont income. So the minimum amount was reduced last session to $250. It was previously $500, I believe. Also, what I did not show in this chart is that there is a special minimum tax that applies to small farm corporations. And small farm corporations are those that are organized for farming, that are owned solely by active participants in the farm business, and that receive less than $10,000 of Vermont gross receipts. And sorry, I had that in front of me. I just want to tell you what that amount is. It is $75. So it's a smaller minimum tax for small farm corporations. Okay. Now, so those are sort of the looked at the tax base and the tax rate, and then I'm actually going to go back and dive a little deeper into the tax base. So what is actually the taxable income that corporations are having that those marginal rates applied to? So if they're not paying the minimum tax, because it's either the minimum tax, it's the greater of the minimum tax or what they would pay under these brackets. So if their minimum tax would be less than what they pay under the brackets, they'll pay under the marginal rates and brackets. This is where most of the complexity comes in for corporate income tax. And last year, there were some pretty significant changes. I think it was 2019. There were also some changes to determining what income is applicable in Vermont, what Vermont is able to count as taxable income for corporations. So I'll start by, on slide 12, laying out how you determine corporate income and how it is applied to Vermont. So Vermont looks at the income of the taxpayer using the unitary combined reporting approach. That is compared to separate reporting. And then it looks at different apportionment factors to figure out what income is actually taxable in Vermont. So those are the two different, I want to say factors, but those are the two different approaches and ways of getting at income that is taxable by Vermont. Moving on to slide 13, identifying corporate income. So this is really the highest level. Vermont used to be a separate reporting state, so each individual corporation would be reporting to Vermont. However, given how complex multi-state and multinational corporations can be and their internal organizational structures, often there's a parent company and a number of subsidiary companies, which themselves may have subsidiaries. There are different ways of getting those many corporations to report to states, either separate or combined. And slide 14 explains these two different approaches to identifying those entities. Separate reporting treats transactions between affiliated companies as though they were unrelated. So it doesn't look at them as a group. This means that intercompany transactions, so perhaps from a sale from a subsidiary to a parent company or between subsidiaries, those could be treated as deductible expenses. And this enables corporations, even if they are in some way related, it allows them to shift income between companies, and that reduces their tax liability. Combined reporting treats these affiliated companies as part of what's called a unitary group, and that's one entity for tax purposes, which means that the group will file just one return. There are sort of pros and cons and different sort of policy decisions behind taking one or other of these reporting approaches. Supporters of combined reporting say that grouping these affiliated companies together eliminates loopholes and any sort of distortions that might be caused by these intercompany transactions, many of which are legitimate, but some which may not be. It makes it one group, so it's clearer that they're all related companies. Those who oppose combined reporting claim that it causes other distortions and attributes income potentially to a jurisdiction that doesn't have nexus. So there are different approaches to this. That said, Vermont did and is now a combined reporting state and has been for quite some time. And I'll go into more detail about the history of that. In terms of legal definitions on slide 15, this is enacted into statute, and it does show up in the Vermont regulations on allocation and apportionment for corporations and unitary combined reporting. And there are different court cases that have set out this test. So the way you determine how corporations within a group are affiliated or related, you can think of it kind of, a lot of these terms sound like family or familial relations. So if they are affiliated companies, they are, so I'm sorry, I jumped ahead. A unitary business means one or more related business organizations engaged in business both within and outside the state. And this is where the court test comes in, among which there exists a unity of ownership, operation, and use, or an interdependence in their functions. So this unity test is ownership, operation, and use, or there's some sort of very tightly linked interdependence in how they function. They need each other to actually function as a group. An affiliated group is a group of 2 or more corporations where there's 50% or more of the voting stock of each member corporation directly or indirectly owned by one owner or owners. So that could either be a corporate owner or a non-corporate owner. So it might be an individual or a partnership or some other business structure. It can also be owned by one or more of the member corporations. Oh, I see. I'm sorry. I did not update this slide. I still have previous statute under here because overseas businesses were actually repealed last year. So I apologize. I didn't catch that. It should not say, but shall exclude overseas business organizations. It no longer says that. It just says now, but shall exclude corporations taxable under 8 VSA section 614, which is captive insurance companies. I'll make sure I update that and resend to Sorsha. So this is the unitary combined reporting groups. So that moving on to slide 16, unitary combined reporting applies to multi-state businesses that are part of a unitary group. These are corporations, put businesses there, but we're really talking about corporations. And the portion of the unitary business that occurs both within and outside US borders. I put as of 2023, and I'll explain later why that's in there. That's because that was also something that was amended in last year's corporate reform bill. And as a note here, unitary combined reporting does not apply to S corporations, although it has the word corporation in it. They are small corporations and they're subject to personal income tax, not C Corp corporate income tax. And then as you just saw in that statutory section on affiliated groups, it does not apply to captive insurance companies. Slide 17 provides a map to show how many states do require combined reporting, like Vermont. So it's a little over half. This is from, I believe, 2020. So this has not been updated, but I did do some research on this prior to presenting this, and I have not found new states that have moved to combined reporting. So this appears to still be the most accurate representation of other states. That there are quite a few changes going on in the corporate income tax world in terms of state sort of tax trends, but moving towards combined reporting doesn't seem to be the most sort of the most recent trend. It's more the early 2000s. So I'll just pause there just for a moment before I move on to allocation and apportionment. So the reason why I just went through all of that unitary combined reporting is that those are the complex C Corps that are going to be looking at these complex apportionment factors. When you have a smaller corporation, when there aren't subsidiaries, there aren't multiple groups or multiple members of a group, you don't have to do all of this analysis. This is really everything that comes after this in the presentation is really for either multi-state or multinational corporations. And I'm just actually not sure if I included that in here, but this is also, this is only for US incorporated C Corps. Vermont's corporate tax does not apply to foreign incorporated corporations. Okay, so moving on to slide 18, corporate income tax allocation and apportionment. So again, as we're looking at multi-state corporations, we know that there are many that are complex. They have multiple members. They're part of a unitary combined reporting group. Because they have these multiple entities when they're grouped, they're typically operating in and they're earning income in different jurisdictions. It's very simple when a C Corp is earning income entirely within Vermont, then it's all Vermont income. It's all going to be subject to Vermont corporate income tax. It's rarely the case. These are complex entities and they generally have multiple jurisdictions where they're operating. So when you have income both from within Vermont and outside the state, it needs to be apportioned. And that is subject to constitutional rules because Vermont can only tax income that is earned within its taxing jurisdiction. So when a corporation has income from multiple places, Vermont law will apportion it based on a statutory formula. And historically, moving on to slide 19, the apportionment formulas looked at property, so actual real estate in the state, payroll, so employees working in Vermont, and sales. However, this is more the area where there's been a lot of change throughout the states and they're in different corporate income tax codes. The trend has been to put more emphasis on sales, so sales that are occurring in the state. Vermont moved to what's called a double weighted formula back in 2004 when it shifted prospectively to a combined reporting requirement. And it was and has been double weighted up until January 1st of this year. So that was one of the changes that was made in last year's corporate income tax bill. It's now the only factor that's taken into account when apportioning corporate income. So now it's called a single sales factor. Now Vermont, when looking at corporations that have income inside and outside of Vermont, they only look at sales made into Vermont. And I didn't note this on here, but I do want to just remind those of you back in 2019, Vermont changed determining whether sales are made, where those sales are made, changed from what was called a cost of performance state. And Vermont is now a market-based sourcing state. So it looks at sales that are made where the market for those sales is Vermont. So there's been quite a shift away from looking at physical presence with employees and property and looking at sales and the sales being made into Vermont, not from Vermont. And I've included on slide 20, I'm sorry, it's a little small. If you can zoom in, you'll see it still lists Vermont as double weighted with sales. And I've just put a little text box here to remind everyone that this graph is from a year ago. It's periodically updated by the Federation of Tax Administrators, so state tax administrators. This is from their website. Vermont did move to a single sales factor state. Other states are doing it progressively. Some are doing it over a few years, but you'll see where it just says sales. That means it's a single sales factor state, where they only look at sales as the factor for determining how much income from these unitary combined groups is attributable to Vermont. There are lots of different ways of looking at income and determining how to apportion. And I've tried to keep this really brief, but I did just want to provide a short explanation of what sounds like James Joyce. There are two California tax court cases called Joyce and Finnegan. And these looked at different unitary combined groups, entities, income. And there are different ways of deciding whether a state has jurisdiction over that income by considering unitary groups in a different way. So Joyce, which Vermont was up until January 1st of this year, that method looked at each entity in a unitary group as a separate taxpayer and then determined whether that entity had nexus in the state. So even though the group would be reporting, each individual entity had to be considered and whether their income would be included in the apportionment factors. Vermont, as of January 1st, has moved to the Finnegan method, and this also seems to be the general movement and trend within state corporate income tax, is to look at a unitary group as one taxpayer, so that if any one taxpayer has nexus with the state, all of the taxpayers will be, all of their income will be included in the apportionment factors. So even if that, so I'll take an example of one entity in a corporate group is operating in Vermont, is making sales into Vermont, that then pulls in every entity within that group, their income is included in the apportionment factors. That doesn't mean that income will necessarily be taxed. It just becomes part of the calculation. Okay. So we're moving on to recent changes. I'll just stop there. I didn't provide many examples here. I was hoping to keep it fairly high level, but please feel free to ask questions if any of that was unclear. I know that was a lot of information thrown at. Some of it's familiar to some of you, but it's always it always is more complex when you actually get into the details.
By all appearances, people are following along swimmingly.
Wonderful. Thank you. And I'm sorry, it's hard to see all of you. The most recent changes that I've laid out here, there are two acts that are relevant to corporate income tax and how it does or doesn't really impact Vermont. These acts were federal. We talked about the Tax Cuts and Jobs Act in terms of personal income tax. It also made corporate income tax changes. It moved from a modified worldwide system to a territorial system, which means it's really looking at income that is within the US borders. It also required what's called a repatriation of profits. So looking at foreign profits and requiring them to all be repatriated. So sort of brought back into domestic corporations' income and subject to one-time tax. And I'd be happy to put together, that also gets very complex, but that's looking at subpart F of the Internal Revenue Code and something called GILTI. There was a one-time repatriation that did lead to a small bump, I think, in Vermont's corporate income tax revenues. So that there, and then there was a decrease in corporate income tax rates. None of those did, other than the repatriation of profits, because that flowed through to Vermont. The rates and the other changes did not impact Vermont corporate income tax. I do just want to note that the federal corporate tax rate was lowered from 35% to a flat 21% by the Tax Cuts and Jobs Act. And then because the tiered income tax rates were repealed, as well as the 20% alternative minimum tax. That has since been changed in the Inflation Reduction Act, but I'll hold off just a moment. But from 2018 through this past year, that 21% has been the flat corporate rate at the federal level. Because Vermont does not link up to federal tax rates, that did not have an impact on Vermont, and Vermont did not make any changes. Like I was just referring to the one-time repatriation, GILTI, and the subpart F rules, that did lead to a small bump for Vermont revenues. But there was no change made in response to that, to the federal changes in 2018. Moving on to slide 23, the Inflation Reduction Act did enact a corporate alternative minimum tax. So that is slightly different from what was done in, the opposite of what was done in Tax Cuts and Jobs Act. So there is now a book tax that applies to sort of the financial statement. So what corporations have on the books for their profits, as opposed to what they're reporting for tax purposes. And that only applied to corporations with profits of more than $1 billion. And that is effective starting this tax year, 23. There was also a 1% excise tax on the fair market value of corporate stock buybacks. And I've not prepared anything in great detail on those because, and I'd be happy to if you'd like me to, but they do not have an impact on Vermont because, again, we are not linked up to those provisions. And we are not linked up to the rates, notably. In terms of changes last year, I have alluded to several of those and tried to provide some background, and I'd be happy to provide more detail on any of these changes if you'd like. That was an Act 148, an act relating to changes to Vermont's corporate income tax. That also,
how do you feel about?
Sorry, one second, Abby. Having some technical challenges.
oh, okay.
Am I? Yeah, sure. Somebody shut it up. Here we go.
And what is it?
Thank you. That's right. Person's a good. Thank you. I'll get back when I need to.
We have solved our technical challenges and we are returning to you, Abby.
Great, thank you. I appreciate I'm sort of flipping back and forth, so I wasn't actually looking at what was happening. I appreciate that. Okay, so the changes that were made in Act 148 last session, as I said, do only apply starting January 1st of this year. So you won't see the changes until next year when corporations are filing. Corporations typically request extensions, so it's later in the year. It's not, March or April, it's more the fall when you start getting that sort of data. So that'll be in 2024. The changes that I've listed here are what I covered regarding the single sales factor. That was one of the major changes. Vermont did shift to the Finnegan method. So looking at unitary combined reporting groups as one taxpayer. And I sort of alluded to the 80-20 rule when I said, oops, I have an old statutory language in there. So overseas businesses, that was a statutory definition that when a US corporation was operating primarily abroad, so it had payroll and employees abroad, if it was 80% or more of that corporation's activity, they would not be included in apportionment factors. The legislature repealed that rule. So now if a US corporation is operating abroad, it is still required to be reported on the unitary group's return. Also, what I didn't get into, because that also gets very complex, that there was a throwback rule where, because of a federal law that was never even enacted into statute, but has been in effect, I think since the 70s or 80s, Public Law 82-172, I think, where it says that if a sale is made to the US government, or is a sale that a state does not have nexus over, then that state cannot tax it. That also gets into some sales tax rules around solicitation, when you can't tax sales that are purely solicitation. Those aren't considered something that the state has nexus over to tax. So the throwback rule used to claw back that income if it was made in another state. Vermont repealed that, so those sales are no longer thrown back into the apportionment factors, even though combined with the Finnegan move, you're still getting all of those corporations reporting. It's just that income isn't necessarily being included because it isn't thrown back. The final change was the change to the minimum tax. So new brackets, there were several new brackets added and the amounts were changed. And that concludes my part of the presentation. I'm happy to go into more detail about any of those pieces. There are a lot of moving pieces that fit together. Hopefully that gives you a good overview.
And there is no expectation in this room that everyone caught all of that and is ready to enact tomorrow. But you're welcome to. Yes.
Today's my day to ask questions, apparently.
Appreciate that.
Abby, I didn't notice anywhere in your presentation any mention of B Corps. So how do B Corps get taxed?
So that, I believe they're taxed, I'll look into that, but I think that that's in addition to their legal structure. I don't know that that is any different from a partnership or a pass-through. I think that that's more of a certification, but I will get back to you on that to confirm. I'm not that familiar with B Corps.
I believe you're right, Abby. Okay. Anyone else? Yeah.
Thank you, Madam Chair. Abby, you mentioned that S Corps are pass-through like LLCs. LLCs, as you mentioned, could elect to be taxed as corps rather than through the personal income levies on the principals. Why do we retain, or what's the advantage to an S Corp, and do they have a similar option to choose their tax liability?
I don't know off the top of my head. I have looked into that in the past, but I'll have to get back to you about whether they can also, that's a federal rule, whether that allows the LLCs to be taxed differently. And I know that S Corps are often not necessarily that small, especially by Vermont standards. So I'll get back to you on that one. That's a great question.
Just to follow on, you may know the answer to this one. The advantage to that over a partnership or LLC goes back to the liability issue of the principals, as in C Corp. Yeah, that's what I figured. Thank you.
Yes. So a limited liability corp does provide more protections than a partnership or a sole proprietorship, but it's but it's taxed differently.
But S corps also have the limited liability. Yeah, thank you.
That's right. It's just that they're small, but I don't remember what the threshold is. I just remember that it's quite large for Vermont business.
Standards, yeah.
Well, thank you very much.
Very
Appreciate
welcome.
you zooming in today, and we'll see you
Yes,
soon.
thank you.
Come on up.
Mine's pretty quick, so we shouldn't eat into your break too long.
I think there's a superstition here in the legislature that we never say that.
Sorry.
You never know what happens next.
That's a fair, I will try not to ever say that again.
You're welcome to, Friday the 13th.
Oh, it is Friday the 13th. Look at that. All right, so I just have a quick presentation. I said it again. I have a presentation about corporate income tax, similar to what I did with the personal income tax. So it's got some of the numbers, some charts, and then sort of threading through those 6 principles as it applies to the corporate income tax. So the first, I'm on slide number 2. Yeah.
Sorry. Will you introduce yourself for the record?
Sorry. For the record, Emily Byrne from the Joint Fiscal Office.
Sorry to confuse you with the Friday the 13th.
No worries. I also sometimes forget to do that, so it's happening. You can remind me for the next 10 weeks. So on slide number 2, this is just a repeat of what Abby had. She had a lot more detail on this in terms of who this applies to, but I thought it'd be a good reminder, right? Only corporations, not pass-throughs. And that the last bullet on this slide, just sort of wanted to call out for everybody's awareness, right? Abby spoke about the minimum tax. About 3/4 of filers pay the minimum tax. So in 2018, which is the sort of best year data that I could pull, that was only about $2.3 million. So if you think about all of the corporate income taxes, 75% pay $2 million, 25%. In 2018, I think we collected about $96 or $98 million. So a significant chunk comes from only 1/4 of the filers of the corporate tax. After Act 148, which was the major changes that went into effect last year that changed the minimum taxes, the minimum tax itself is likely to double is what we projected, but it's still out of $100 million, only about $5 million will come from the corporations paying the minimum tax. And slide 3, I'll just quickly glance over that. That is this idea that profits that are passed through to owners are paid through the personal income tax, not through the corporate tax. On slide 4, this chart should look similar to the one we had for personal income tax, but this is the corporate income tax collections since 2005 in nominal dollars. You'll see that in 2005, about 5.8% of the general fund revenue came from corporate taxes. And then it bumped up to about 7.5 right before or during the pandemic, and then jumped in FY22 to almost $220 million and was about 10% of the general fund revenue. But you can see a little bit more. It was a little bit, the personal income tax, if you recall, had a little bit more of a predictable slope to it. This one has a little bit more variability in it.
Representative Beck?
Emily, on slide 4,
Yes.
does that slide just refer to C corps or to all corps and all of the different LLCs that you mentioned on the previous?
Just the C corp.
Just C corps?
Yeah.
Okay, so.
So this is just the corporate income tax line. You'll see in the revenue forecast, there's a corporate income tax line. This is just the tax on the C
Can I make a
corps.
follow-on point?
Of course.
So 3/4 of our corporations are paying $4.8 million expected. And the other 25% are paying the balance of $220 million. Okay.
Yes. And just I'll caveat everything from a data perspective, we're going to be kind of in a little bit of a limbo space for the next 2 years because the new corporate tax goes into effect this year based on when people pay, based on their fiscal year. And then a lot of them file extensions. So then we're not going to have, first year of real good data on the changes probably won't be until 2025. or 25, probably not till 25. So we're going to be in this funny like limbo period in terms of what the numbers are and what the impacts are. But
Can you explain a little bit more about sort of fiscal years and how corporate income tax has more anomalous fiscal years? And
I can do my best. Is Abby still there?
she is.
She's still there. She may have to jump in. I know she's got snow day today, so it's keeps things fun.
She's appeared.
Yes.
Abby, do you mind jumping in?
Do you know that I can?
Yes, sorry. What would you like,
The
Emily?
question. Yeah, a little more detail on how fiscal years and corporate income tax works. I think it's and how it's sort of different from personal income tax.
Yes, so I actually meant to look up the actual date because it has changed over the last couple of years when corporations have to file. It's a different date. I think it's March, but let me just check because it changed federally as well. But what corporations typically do is they extend. So they're typically filing in the fall. In terms of fiscal years, different corporations have a different fiscal year. So it could start at a different point. And that also is part of their filing and their reporting of receipts. That answers all of your questions, but let me just confirm.
Wait, we have a
filing date.
we have a question, but maybe you need to confirm first. Let's see.
Just pulling the filing date, sorry.
Okay.
Yes, it's on the date a US corporate income tax return is due. I'm just looking that up. I'm sorry, I should know this off the top of my head. Go ahead.
We ready?
Yeah.
I noticed the same thing that Representative Beck noticed, and I'm trying to think what that means. The fact that there's 3/4 that are at the bottom and but a massive amount is still coming in. I mean, it's going to take me a couple hours to figure out what that means. What does it mean? Is there a way of summing up what we're concluding from that?
So I think generally I would think about it in terms of potential volatility in receipts, right? So if you're relying on a smaller amount of corporations for the vast majority of the revenue that you're receiving, if and when there are economic changes, either generally or to a specific sector, depending on how much of that sector makes up the corporate income tax. So manufacturing or whatever, something hits one of those and there's a potential,
I see.
a greater potential for reduced revenue.
So if one of those
tax.
companies left the state, you could see a drastic drop in corporate income tax.
Potentially, yeah. Or sometimes when there's a sale of a business, you see changes in the corporate income tax.
Okay. Okay.
And I did just confirm, looking at federal dates, it's the 15th day of the 4th month following the end of the corporation's tax year. So that's why there's also so much variability there. And then they typically extend 6 months as well.
Yeah, so if you're a corporation whose fiscal year starts in November or October, which would start of 2022, you get 4 months after that, right? So there's a whole lag associated with that. Yeah, exactly. All right, so I'll keep going along. If we go to slide 5, this one I know we've talked about sort of volatility a lot. This slide just takes the difference in collections from one fiscal year to the next and graphs the percent change. And I think it does a pretty good job of sort of demonstrating how what the changes can be, and that, to point out the scale on the side, it's in, tens of percents, not 1% changes. And there's movement that happens due to business cycles. So quick, I can go over the, thinking about the corporate income tax and the 6 principles. I'll jump right to slide 8, since you all have them memorized at this point, of course. So the first one, sustainability and reliability. We just talked about the volatility. Business income the business cycle is impacted by general economic conditions generally. This idea that a large amount of money comes from a small number of filers. And revenue can be greatly impacted if there's a bad year for a small number of companies or a bad year for a sector. Similarly, if there's a sale of a business or the feds do something that changes, there can be significant spikes or dips in our revenue. One interesting example, I was listening to Marketplace, not yesterday, the day before yesterday, and they had a little blurb about California and Texas state budgets. And one of the things they talked about in California, because there's such a reliance on the tech industry, their budget is in trouble because the tech industry is moving towards in trouble. So sort of thinking about not just sort of corporate tax, but that sort of sector idea and what's going on in individual sectors could potentially have impacts on revenue streams. And then liability, same idea, the economic cycle can impact corporate taxes. We go to fairness. So the corporate income tax is progressive. There is a higher rate for the greater net income that you have. And higher income corporations pay a higher proportion of their business income in taxes. Simplicity comes, I would say the corporate income tax is pretty complex. Based on Abby's presentation, right? It's one of the defining what's in and what's out in terms of income, defining nexus. We just went through a whole big corporate tax reform to try to change some of those things. Thinking about different tax structures and foreign versus US subsidiaries and legal jurisdictions and making the decision about Joyce versus Finnegan, which I'm still not sure I totally understand, right? But like that, all those complexities sort of in the corporate tax code. Economic competitiveness. It is hard to compare, similar to the, it says personal income tax on the top, it should be corporate, we'll change that. It's difficult to compare across states because states use different income tests, the rates are different, how they determine nexus, right? Abby had that slide of sort of how everybody apportions differently, so it's hard to compare across states. Tax neutrality, so this is the idea, right, that we're incentivizing certain behaviors through the tax code. There are some credits and deductions in the Vermont income tax code to incentivize certain behaviors. A good example of one is the downtown, some of the downtown and village tax credits, so you can get corporate, that's what I'm thinking of, yeah, where you can get credits for making improvements to buildings in a downtown, for example. And the last one, accountability. Similar to what we've shown before, but the tax expenditure report will be out on Tuesday. There are 14 current corporate tax expenditures. One of the things that's tricky with the corporate tax expenditure report is that because of suppression issues, so we can't report data if there's less than 10 entities claiming the credit. We can't report the information. So a lot of the only one that we were able to report on is the research and development tax credit, which was about $2.89 million in 2021.
I'll wait until we get to until we get to the expenditure report.
That is that's it.
When we have the expenditure report,
Yes.
Are you able to report on the total value of the corporate tax expenditures, even though you're not able to report on the individual value of the corporate?
I believe all that we have is this R&D tax credit in the report right now. But I can ask the tax department if we can get the total.
The sum seems possible, right? Okay, thanks.
I'll find out.
Any other questions, thoughts? Thank you.
Great.
Very much.
Yeah.
Look forward to getting to dive into this one. Yeah. So we are going to take a break until 11:20. And then we will get two more bill